Hello and welcome to Moneylife News and Views. I'm Debashis Basu. There was much alarm, surprise and consternation last week when the market regulator, the Securities Exchange Board of India, released a study. And the study showed that 90% of active traders or any sort of traders dabbling in futures and options, which is also known as the derivatives market, actually lose money. 9 out of 10 lose money. That was the situation in financial year 22. Well, SEBI took two separate periods. So they said that let's look at pre-COVID period. And then they found out what has been the situation in 18-19. That year, 87% of derivatives traders were losers. Now, the number of individual traders who traded was in SEBI's sample taken from the top 10 brokers in the equity, futures and options segment. The number, you'd be surprised to know, was just 7.1 lakhs in 2018-19, and that number had jumped to 45 lakhs plus in FY22, a rise of 500% in just 3 years. Of these, 88% were active traders. Now just think about this. 500 increase in active traders. You would think that everybody is making money, so people are jumping into the game, but no, more and more people are losing money. 9 out of 10 have lost money. This is why a lot of people called FNO simply a casino. It's a casino for people who do not know how to play it, and most of them do not know it. Now, if 9 out of 10 people make losses in derivatives over different time periods or over different sample sizes, it shows how harmful and useless derivatives are. So the obvious thing for a lot of people is to simply ban them. And if 9 out of 10 people can't make money, obviously it doesn't add value. It's like cigarettes, it only harms you. But like cigarettes, I'll show you the parallel with the FNO as well. It's actually a complex issue. Why? Because a lot of people will jump into it saying that, well, some people know how to do it, big players know how to do it, and they can hedge their positions. And if anybody gets into it and continuously make losses and keeps at it, you can only blame him or her. Another set of people blame the mushrooming broking companies. With an app and algo, you can just get into it and start trading. So that's a lure of easy money. It's a lure of easy execution of trades and so on. And sure enough, nearly 35% of the FNO players were 20 to 30 years group, very familiar with apps and algos and so on and so forth. This constituted just 11% in FY19. Now, another predictable outcome is a demand for more curbs on individual FNO traders. SEBI's reaction is also along the expected lines to issue guidelines for additional risk disclosures to investors by brokers and exchanges, as if, well, SEBI could benefit from a further study. They have been increasing their rules to make more disclosures. So SEBI can do another study. What is the outcome of before and after of risk disclosure for various products? And it can check whether disclosures achieve anything at all. In my view, they achieve nothing. It's like disclosing that cancer. If you have cigarettes, you will have cancer. It doesn't reduce the consumption of cigarettes. How should we treat the study on derivatives? Are there any policy implications? Should derivatives be banned for individual traders at all? These questions cannot be addressed before we understand an equally important fact, and that is hidden in all the discussion you would have heard so far. SEBI's report talks about it only in passing. My question is, who has a vested interest in the massive trading volumes generated in the derivative segment? Who gains from the higher activity of the casino? While the story of 90% of traders losing money is startling, equally significant is a piece of data that appears at the fag end of the SEBI study. Whether they make or lose money, traders have to incur transaction costs, including brokerage, exchange fees, turnover fees, securities exchange tax, etc. These make up a very large portion of the total loss. According to SEBI's own study, in FY22, over and above their own net trading losses, losers in the group of active traders were out of pocket by an additional 28% of net trading loss as transaction costs alone. Even active traders making trading profits, a small number, 1 out of 10, incurred 50% of such profits as transaction costs. Transaction costs for traders are actually revenues for 3 entities. Just remember that. Who are these 3 entities? What the SEBI study will not tell you is how much money is being collected by these 3 entities on every single trade, irrespective of anyone making gains or losses. The higher the trading volume, the higher is the guaranteed income. These 3 beneficiaries of the casino are SEBI, number 1, the entity which did the study and which wants more disclosure. That is, they charge turnover fees. National Stock Exchange, the single biggest beneficiary, a variety of fees and charges, and then the Union Government, which collects GST and securities transaction tax, and the Maharashtra government, which collects stamp duty. Then there is brokerage cost, of course, although all brokers now charge a flat fee, something around 20 rupees or so per trade, irrespective of the size of the trade. So brokerage is really a very small part of it. The biggest cost for traders is all these charges that go to SEBI, NSE, and the Government of India. But all these 3 entities continue to extract their pound of flesh as a percentage of trading volume, while brokers charge a flat fee. All right? This means it's a percentage, right? Which means the higher the trading, higher is their revenues. That leads us to this depressing conclusion. Even as the number of traders jumped 500% in 3 years and trading volumes exploded, even as 90% of traders lost money, these 3 entities profited immensely at their expense. Of them, 2 are government entities and 1 is a monopoly. The biggest beneficiary is the monopoly, the casino owner NSE, where F&O trading has grown a stupendous 5-fold in less than 4 years between FY19 and FY22. NSE's annual report very proudly displays that it has 39% of global derivatives volume in terms of contracts, far ahead of Brazil, which is 17%, and Iran, of all places, which is 14%. 2 markets of the US, Nasdaq has just 4%, and Chicago Board of Exchange another 4%. They are way behind, which means no other rich country, no Japan, no Korea, no Germany, nobody is anywhere in the top 10 list of derivatives casino. India is way ahead. The overwhelming source of NSE's profit is 100% dominance in F&O, that is the derivatives markets of futures and options. How profitable is this casino? Its already obscene net profit has gone up from 1,709 crore in FY19 to 5,198 crore, a jump of 3 times in 3 years. NSE's operating margin last year was 78.6%. That is, if they make 10 rupees, they get to keep 7.8 rupees almost, and a net margin of 59.5% after all the taxes and all the costs. 59% net profit margin. There is no large business anywhere in India, possibly anywhere in the world, which makes this kind of margins and profits. As NSE's annual report claims, in 10 years, volumes in single stock futures derivatives increased 5.4 times. In FY22 alone, derivatives trading jumped 20%. While the story of derivatives casino is startling, with its revelation that millions of traders lose money trading derivatives, therefore, you should not expect any change to happen. The NSE has to remain colossally profitable, while just this year, the government will collect 32,000 crore from securities transaction tax, most of it from F&O. While derivatives is a harmful product and we will continue to blame traders for gambling and losing, the show will definitely go on. The casino has to grow bigger and bigger for all 3 to extract they are rising toll. They have just too much of vested interest at stake. That's why SEBI will only come up with more disclosure about the perils of F&O, which will be ineffective. And you will hear nothing, of course, from NSE or the Union Government of India, which are the two main beneficiaries of this game. If you like this video, please click like and also share. Thanks for watching.